Welcome to our new series. This is Driving in Cars with Mineral Guys with Tim Pawul. What's up, Tim? How you doing, man?
Oh, I'm good.
What are we doing here in Pittsburgh?
Well, there are several hubs around the country of where minerals companies are located. You have Houston and Dallas and Midland, Oklahoma City, Denver, and Pittsburgh. And Pittsburgh is your quintessential hub for Appalachia, Ohio, West Virginia, and Pennsylvania for the Marcellus and the Utica Shales.
Yeah.
So we're just in town. We had dinner last night, just catching up with our friends in the space, just talking about doing deals.
Love it, man. Yeah, no, it was a great dinner. A lot of people had a big steak. But yeah, no, it's always good to come. Tim hosts these dinners, kind of quarterly around the country.
Yeah.
And is pretty well known in the mineral rights space. We kind of serve different audiences. Primarily, like, my focus is on reaching mineral owners and providing education and helping mineral owners really understand, the asset class of minerals and what they mean on their personal balance sheets and how to get liquidity when they want it. And then Tim, tell us about, your audience.
Yeah, so I mean, Stephen, you and many of your peers in the space, I always tell folks the mineral space is very fragmented, and you guys are putting Humpty Dumpty back together again. There are family offices and pension funds and insurance, publics, private equity that want to deploy tens of millions, hundreds of millions of dollars, and they want a certain yield, they want a certain type of return profile, but they're not going to do that at the $25,000 investments, $100,000 investments at a time.
Yep.
But they want to do it in one shot. And so you and others are building these what I call institutionally investable portfolios.
Yep.
And so that's the side of the space that I play in. So you're more interfacing directly with the individuals that own, there's probably tens of millions of individuals across the country that own these fragmented interests. And then the cottage industry that aggregates those fractionalized interests is my bread and butter. So everyone in the space that skins the cat a different way, a different type of strategy, different fund structure, different focus in terms of basins and size and scope. I know what everyone does, and I help put money into those funds, raising capital, putting monies into deals, and then help kind of the buy and sell in the A&D market between those funds.
I love it. Let's talk about the minerals ecosystem. Kind of how each of us, fits, right? And a lot of mineral owners and really anybody that's watching that's, maybe interested in investing in oil and gas, that's interested in the space, right? To a lot of just ordinary folks, right? Retail investors, individuals that are used to seeing, real estate deals or investing in stock and bond portfolios, they hear minerals and they just have no idea what the heck we're even talking about. So what a lot of folks don't realize is that the oil and gas minerals industry is estimated to be at north of $800 billion, right? And a very small portion of that is owned by, publicly traded mineral companies.
It's a fluid number. There's a couple of publics in Canada, Franco-Nevada, which is primarily a gold company. They have a pretty substantial U.S. minerals portfolio. You have freehold royalties. So when you account for the Canadian share, roughly speaking, probably 30 billion in the public markets.
Yep.
Private equity is probably somewhere in the 20 to 30 billion dollar range.
Yep.
And then the rest is in trusts. I think if you're going to use, let's just use $1 trillion for the entire market space as a proxy. I've heard estimates around 10 to 11% sit within trusts that, for the most part, aren't really going anywhere. They're set up by families to keep whatever's inside the trust there from generation
There was
to generation.
a guy, who was that guy yesterday that was like, so at the dinner last night, Tim always makes everybody go around the room and give an introduction. And there was one guy that stood up and he said, we are where minerals come to die.
Yeah.
We never sell.
Yeah.
And that's what Tim's really talking about with these trusts, right? These are large, sophisticated families or companies that are really built to hold these minerals and are not really actively participating in the market, right?
Yeah, I mean, think about your Wells Fargos, your JP Morgans. They have wealth management divisions, and within the broader portfolio of families, there are these trusts and these estates, and within the estates you have the mineral estates. And a lot of these folks may not even know what they own, but these large banks have mineral management divisions.
Yep.
And so when you look at 10-11% of $1 trillion market, that's $100 billion in trust. That's a lot of minerals. And I think technology innovation, easier ways to evaluate minerals and get a fair market value, creating transparency will kind of enable these non-sector wealth managers to monetize the minerals in these trusts when it makes sense for the families they represent, just from a fiduciary capacity, right?
Yep.
But for now, that is very much kind of in the drawer, and the key is turned, and that part of the market's kind of there, and it's not going anywhere. But the rest of the market, outside of what we mentioned, the publics and private equity, it's individuals.
Yeah.
And it continues to be fragmented through generational wealth transfer, which is what Stephen, what you and others do. It's kind of a never-ending cycle, right? To aggregate these things.
No doubt, and it's one of the problems that we run into as kind of brokers and aggregators is a lot of folks are, when you inherit mineral rights, let's say it was a 100-acre tract of land back in 1910, right? Well, 3 or 4 generations down the line, I mean, each individual within that family, right, might own, 2 or 3 acres, right? So these assets, oftentimes, as they're passed, they get more and more and more fragmented, and where you could have, Farmer John that is a single owner of fee simple title to a 100-acre tract of land, 3 or 4 generations later, I mean, those mineral rights could be held by 30 or more people, right? So one of the challenges, and I talk to a lot of mineral owners, right, is, what do you really do when this stuff gets so small that it doesn't really mean anything to anyone? And honestly, we transact with a lot of people because I just ask them simple questions around, well, you own 10 acres. How many kids do you have? Right? It's like, well, I got 4 kids. It's like, okay, then it probably doesn't make a lot of sense. It's like, I know people want to talk about legacy and really kind of passing minerals on. And that is important for a lot of families. But, for our mineral, owner viewers out there, I mean, it is important to think about, like, what is that legacy? Is it the headache of having to find a bunch of 1099s at tax time when your heirs may be better served by you just selling what you have now and distributing cash while it's still a meaningful amount of money?
There's an old adage, grandma said, never sell your minerals. That was before the unconventional shale revolution. And, from putting on the finance side, again, my world is investors and the professional groups that invest on their behalf to put these portfolios together. There's something called, front-loaded yield, and reinvesting that yield into undeveloped acreage and then it happening again and compounding your equity. So
yep.
The difference between a conventional oil well or natural gas well is just, it's a lot lower volumes of production out of the gate, and then it's a pretty steady decline over time. And so using, a simple example of a 50-year production life, it's somewhat evenly distributed over that 50 years. But in a shale well, because of the way, I'm not a technical guy, I don't think you are either, Stephen, but the pressure in the reservoir, causes extremely high levels of production out of the gate, and then the pressure drops off. So think of like a hyperbolic decline or a roller coaster.
Or a ski jump. That's the best way I explain it.
Yeah, that drops off a cliff after 18 months. But when you're looking at it, call it 60, 70, 80% of what you're actually trying to get out of the ground is recouped in that 18 months.
Yep.
So when you're a mineral owner and you're looking at monetizing, it depends on the stage of your minerals and everything. And if you're undeveloped, is there activity coming around you? I mean, folks are willing to come and write you a pretty healthy check. Back in the day, it was cash flow multiple.
Yep.
And, there's just a limit to how big that check's going to be. If you're making $300 a month and someone's going to pay you 40 months, you do the math, it's not a huge number. But if someone's saying, hey, I think there's going to be 4 wells drilled, and each well is now $12 million a piece, not $600,000 a piece like it used to be in the conventional space. The scale is very different, and now all of a sudden, that check is significant for the individual mineral owner.
No, no, that's 100% correct. And we've done a lot of stuff in Eastern Ohio, and have got to know a lot of really great folks. And I told you that we went and met with the mayor of Cadiz yesterday, who we bought a few weeks ago. And it's a common theme, because I'm constantly in the market and talking to mineral owners, and especially for folks that are in their kind of mid 60s, early 70s. In areas like Cadiz, right, where you've had unconventional development in the area for, 10 years, right? They still haven't gotten a well yet. And, really, like, the question for them is, how long are they going to have to wait before they get that first royalty check? And so it's a really common theme. I've closed several owners in the Haynesville, that see the same thing. They're just like, it's great that I own these minerals. There's gas in the ground, there's oil in the ground, but by the time that well gets drilled, I'm going to be too old to do anything with it, right? So It makes more sense for me today, right, to get as much as I can in a sale, right, and go take that capital and go do the things that I want to do while I can still do it. So we kind of covered, in a roundabout way, like the base of the pyramid, right, which is kind of the who are the owners of mineral rights.
The way I always describe it is, tiny fish gets eaten by small fish gets eaten by medium fish gets eaten by large fish, and large fish gets eaten by giant fish. And that is what the mineral space is. It all starts with relationships. It all starts typically with people who have some sort of rapport with the mineral owners. That could be you're very local to an area, and you went to the high school, and people in town. Could be someone like yourself, Steven, that's developing relationships with folks through your content. There's all iterations of that, but there's a ground floor level where relationships matter. It's people doing business with people.
Yep.
And some of those folks have enough capital to buy these deals on their own. Some are using a line of credit, personally guaranteed. Some are really just acting as a broker and a middleman. And so that's the first layer. And then every layer you go up in the food chain, the dollar amounts get bigger. The appetite for return usually comes down a little bit. Mm-hmm. So the larger dollars you're willing to deploy, typically the lower return you're willing to take, because you're not doing all the dirty work, putting, like I said, Humpty Dumpty back together again. And so there's a very natural ecosystem that exists there. And what's kind of fun, the space we're in, kind of the B2B space with all the different funds buying and selling from each other. There's different, just like a mineral owner who might have a life event, someone in the family's sick, or there's a wedding, or they want to buy a second home, or a first home, or whatever the catalyst is to say, hey, I need some cash today. Same thing exists in the B2B world. Someone might have a loan out, and the interest rate environment, it's pretty high right now. So there's a clock on how long they're willing to hold something. And if you can move that to someone else and kind of secure your capital and a little bit of return, it makes sense. A sure thing is always better than what do they say? A quick nickel is better than a slow dime sometimes.
Yeah, I like that.
But then you have a lot of folks in our space own real estate. I have an example of someone I sold minerals for a couple of years ago. Has a big portfolio of royalties. They buy and they sell them all the time. They also have a pretty substantial real estate portfolio. That real estate portfolio obviously has leverage on it. And as interest rates went up, the banks were calling for more collateral to hold the borrowing base in place. That sucked up a lot of liquidity on their balance sheet, and they kind of looked around and said, I think selling some of these minerals a little sooner than we wanted to makes the most sense for my overall portfolio. So there's a driver there, and someone can have 1031 money.
Yeah.
And that's something we need to talk about as well, is if you own real estate, folks who are familiar with the 1031 mechanism, basically if you sell that property, you can take those proceeds, reinvest it back into another real estate property and defer the taxes on the capital gains. You could sell real estate property into minerals, or you can sell minerals into real estate, or minerals into minerals. So
I actually did my first 1031 exchange with minerals last year. And shout out to Petroleum Strategies.
Out of Midland, right?
Out of Midland.
Yep.
My girl, Lori, she was amazing. Made it very simple. You know, there are some complexities with trying to execute. Everybody always talks about a 1031 exchange, but there is some complexity to actually like executing it and getting it done. So the big thing is that you have to have a replacement property, right? And correct me if I'm wrong, CPAs out there, but I believe that the property has to be identified within 90 days, and you have to actually execute on the replacement property within 180. But as long as you can do that, then yes, I mean it's an unbelievable way to be able to basically, like, I was able to exit a minerals deal that we bought back in 2020. I actually went into a real estate deal, and I didn't have to pay any tax to the federal government, which is like, that's a beautiful thing.
It's a tool that's used by the real estate world regularly. I think rough numbers here, I think 1% of the 1031 market is covered by minerals. And there's no real reason for that, other than I think a lot of people don't know it's a mechanism that exists. And so I think that'll grow over time, but it's just it's a tool in the tool belt. So when you go back to the ecosystem, it's just one of the drivers that can trigger deal flow.
Yep.
And then there's the other thing of, you know, these are professional investors with a return in mind. This is not a generational, family jewel type dynamic. It's a private equity firm that says we're in it to make X percent return.
Totally.
In X number of years. And so as you think about using a real estate analogy, you're going to have Class A real estate in downtown New York City, in Manhattan. And then you're going to have some undeveloped acreage kind of outside in the outskirts of town. Maybe you've heard of a plan for a new mall to be built in some residential communities. You know, that's the analogy of oil and gas development coming. It's a lot of imperfect information, and you know, now that a mall pops up with hotels and there's restaurants, okay, now it's a little more attractive, it's more valuable. Then a master community gets built. Okay, there's some schools popping up, the value goes up. And this is the same thing with drilling activity around your minerals and permits dropping, and so a professional investor, as the value of their undeveloped acreage starts to appreciate with all the different things that can happen, it might be time to punch the ticket and exit to someone else who is starting a new fund that needs acreage like that and may not be in year 5, 6, or 7. So,
and bring up the mineral development curve, right? And this is one of the things that I talk about in a bunch of different videos, and that's really what Tim's kind of alluding to is basically you've got a curve that looks like a bell curve, right, with a line, right, a vertical line up and down right through the middle, and everything on the left side of the curve is basically undeveloped minerals, right? And so the things that Tim's talking about, right, where you've got totally undeveloped minerals unleased, you know, activity starts to happen, and then that value starts to inch up, right? So a lease might be taken, permits might start to be taken in the area, right? A drilling rig might show up. And the way that I explain it to folks, Tim, and tell me what you think, is that basically the lump sum value of minerals reaches its pinnacle at the moment in time just before production, right? So you've got, you know, basically unleased, leased, wells in progress, WIPs, you know, permits, drilling activity, DUCs, and then at the very top of that curve,
DUC stands for drilled uncompleted
wells,
and then you have completed.
Yep.
But, you know, not necessarily tied into midstream infrastructure, not getting revenue yet, and then it comes online and produces. And you're right, because these new unconventional wells come on so hot and heavy in the early period, depending on when, where gas and oil prices are, you can capture that revenue at a high commodity price. There's a lot of return to be made. So folks, typically right before a well comes online, that's the frothiest to sell something.
Yep.
And there are investors out there looking specifically for that kind of investment profile, and others want more undeveloped. Some want an existing cash flow stream. There's just so many different types of investors in the market. And going back to the ecosystem comment, the ecosystem on the investment side is starting to mature. And so you have income investors, and you have generational family offices that want to buy stuff and put it in a drawer for their great grandkids, and so they're willing to speculate a little bit more. And then there's folks who just I would say the meat of the market, we'll call it private equity. They want a third of development, a third of near-term development, and a third of really that undeveloped acreage. So that kind of gets you your blended yield profile that kind of replenishes over the first 5 years that the public markets want, private equity wants, and so that's a majority. And then on that bell curve you're talking about, there's people on the right side of the bell curve who want super undeveloped, and there's people on the left side of the bell curve that want almost no risk and just wells that are over 3 years old, very, very predictable.
Yep.
It's cash flow. And so together, collectively, the market, there's always a home for this stuff. Right?
Yeah, and you talk about the little fish getting eaten by the medium-sized fish, getting eaten by the large fish. There's a lot of people that...
It's an interesting debate. I ultimately think the end buyer is the individual retail investor at the end of the day. Now, you could say it's a public company, which essentially backs into being a retail investor. I think there will be, with blockchain and technology, at some point in the future, it's complicated to execute this because of title and the complexities of really understanding the engineering of oil and gas interests and the value. But I think there's going to be one day where you go onto the computer and you say, I want to own $25,000 worth of Midland Basin minerals under Pioneer XTO. And there are fractionalized shares on an exchange, just like you would buying shares of Apple, and boom, and you execute the order. That doesn't exist today. I think we're still ways away from that. So I think that is where we end up at some point. But in the interim, I think it's the institutional money that kind of represents that retail money, pensions, insurance, publics, and then family offices that are really more evergreen in nature, and that there isn't a close-end fund term. They're just looking to invest, get the cash flow, and kind of hold it into perpetuity. So it's a moving target. I think international family offices is a very viable candidate for the ultimate end holder of this stuff. And the reason is, owning real assets in the U.S. is, I think, something you and I as Americans take for granted, Stephen. We're not really worried about the government taking our home or taking assets in our portfolio. There's a very real threat in certain parts of the world. And so protecting your wealth through politically safe jurisdictions like the United States, and then on top of that, owning a real asset like a minerals interest is very appealing.
And having private ownership of minerals here in the U.S., which there's a lot of places in the world that just doesn't exist.
We're the only country in the world that exists outside of small pockets in Canada, but every other government in the world owns the minerals in the ground. And so the ability to own private minerals, and there's a good segue to talk about kind of the benefits of owning minerals. But I think I represented a family office in Switzerland years ago that's investing hundreds of millions of dollars now in natural gas royalties. I look at that as a case study to say this is, they have a very low risk appetite. They want to own production. and their underwriting was 60 years, and they mean it. They're underwriting stuff for a 60-year hold.
Wow.
So I just think there's versions of that all over the world, and the more educated folks get on this asset class, the more Humpty Dumpty gets put back together again and into portfolios that large groups like this can access from overseas. And it becomes an amazing asset class to own and manage, because there aren't toilets to fix. You don't have equipment in the field. You don't have HR and people to manage. It is a financial instrument at the end of the day that kicks out revenue and doesn't have operating costs. And so that becomes very appealing as a passive portfolio, portion of income generation in your investment portfolio, for sure.
Yeah, no, I mean, there's a lot of reasons to love minerals, and it's funny because when I'm talking to mineral owners, I can't on the one hand say, oh, this is the best asset ever. On the other hand, oh, by the way, you should sell it to me. The reality is that there's a lot of really good reasons to want to own minerals, right? There's also a lot of good reasons to know when to sell, right? And to know when is the time to get liquidity or to exit. But, for folks out there that are considering investing in minerals, right, whether you're an individual investor or, family office, whether here in the US or internationally, the beautiful thing about mineral rights is that, I call it 100% pure margin business, right, where we have our acquisition costs associated with buying a deal. But once, I buy the deal, the deed is recorded, right? We notify the operator, of the transfer. There are no other affirmative steps that I really need to take in order to manage that asset.
Yeah, and you have with the Texas, Arkansas, and West Virginia, the property taxes pass through the mineral owner.
Yep.
That's the only real expense.
That's right. Yep.
Shout out friends of mine at Merit Advisors in Dallas. Yeah. They proactively go out and protest the property tax value on your minerals. And they do it in a very sophisticated way using oil and gas engineers and everything, and can contest the value on your behalf with the local tax authorities to then lower your tax exposure. So it's a great service. But outside of that, if you own minerals in New Mexico or Oklahoma or Colorado,
Louisiana,
there aren't property taxes that pass through. It's kind of covered by the operator.
Yep.
So it really is collecting mailbox money. And then if it's undeveloped, I think there's a line in the sand of, if you own a mineral portfolio and you do know what you're doing as a landman like yourself with your background, Stephen, of negotiating lease bonuses, getting in pay, holding the operators accountable that your decimal interests are correct, there is a hands-on management aspect of owning minerals where you can create a little bit of a delta there. But all things considered, compared to other things like real estate,
absolutely,
way simpler. Simpler.
No, that's right. I mean, you got to make sure that you're being paid correctly, for sure. But it's and there are a lot of great tools out there, to help large mineral owners really kind of manage minerals and manage activities. But compared to operating oil and gas wells, which I also do, or managing a real estate portfolio, it's a beautiful asset, right? Just in terms of the fact that there are no operating expenses associated with it, right?
Yeah. So here, let's use this is a metaphor I tell investors all the time that are new to the asset class. I go, imagine you invested into an apartment building, and the apartment building is 10 stories, and you have your associated kind of rental income with each floor, the number of apartments, etc. And then 3 years after you make the capital investment into the apartment building, the owners of the apartment building say, you know what, we're gonna add 10 more floors, or we're gonna put marble floors and really make this a top class apartment complex, and we're gonna add a pool, and we're gonna do all these amenities that's gonna increase the rental income. As a mineral owner in that example, you do not pay for any additional construction, any additional upgrades. So what would that look like in an oil and gas metaphor? drilling new wells. That's the analogy of the new floors being added. There's something called enhanced oil recovery, EOR. You're going into existing wells and you're increasing production through different types of technology that exists. And so that's the example of, upgrading the apartments and putting a pool, and so that just increases revenue. And the beautiful thing about being a minerals owner is that you get your proportionate share of that increased revenue, that additional revenue from new wells. You do not pay a single cent in any of that new capex, which people they can't wrap their head around it. And that's the serendipity upside value of owning minerals, is how we refer to it in the space.
Yep.
And, to a certain extent, professional firms are giving some sort of value to this serendipitous upside, but because you never really know when it's going to come, a lot of it is it's a discounted cash flow model. You're discounting that cash flow coming on the future, and it could be anywhere from 20, 30, 40, 50, 60, 70% discount rate, because you just don't know. But you got to love the American entrepreneurial spirit, how the oil and gas industry reinvents itself year on year, technology innovation, getting oil and gas out of the ground cheaper, going and accessing oil and gas in areas that were uneconomic previously that are now very economic, and just cracking the code on doing a better and better job every day. As a mineral owner, you're getting a free ride on all that. And there's just countless stories of this happening. The Permian Basin's an amazing example. It's just the beast that keeps on giving. But there are, you mentioned you were buying some minerals in Ohio recently. There's an area in the western side of Ohio that is an oil shale window. Ohio's predominantly known for being a gas play. 10 years ago, Chesapeake and other household names on the operator side swung and missed on this oil window. And Encino, EOG, some of the world-class operators that exist in our industry today have figured it out. And so that example is going to continue to happen over and over and over again, which will continue to, de-risk the value or bring the value forward on mineral ownership for decades to come, which is what makes it such a great asset class to own. Now, to your point, Stephen, maybe waiting 2 decades doesn't make a whole lot of sense for you, and getting some cash up front today to diversify and reinvest into other things, or, hey, we're on this earth to enjoy life. Get a car, get a home, go on vacation, give that dream wedding to your daughter, whatever the mode may be. It's individual to every single person, every single investment firm, and that's why real estate, there's always building and buying and selling of homes and commercial properties, and it's the same thing in the minerals.
No, that's exactly right. And that's one of the big things that no one has an issue selling their house. Like you buy a 3-bedroom, 2-bath house when you and your wife first get married, right? Well, what happens? You have a couple of kids and you're like, we need more space, right? Mm-hmm. So no one hesitates, right, to sell that house and go buy another one, right? Or to trade one asset for another, but in minerals, it's like I do run up against folks that are hesitant to sell minerals, right? They don't want to participate in the market. And I think one of the big differences between those two markets is really just that oil and gas assets are just more complicated. There are more factors that go into
understanding. You can't go onto, Kelly Blue Book or whatever and just, see, I have X square footage in this neighborhood, I have a pool.
Exactly.
I have X number of bathrooms and my square footage is worth X. It's not that simple, unfortunately, but we're getting there. It continues to get more and more transparent.
No, that's right.
A lot of what you're doing, Stephen, is just being transparent and trying to get people comfortable. I do the same thing on the investment side. I was in New York a couple days ago. I was in Los Angeles 3 weeks ago. And you sit down with these families and you just get them to understand what minerals are, and then I'm an open book. I say, hey, you want to see what all these funds are doing? Here are the different structures, here are the different terms. You can feel comfortable that you're getting a fair deal, and it just depends what you're trying to achieve. And it's the same thing when you sit down with a mineral owner. Hey, what are you trying to achieve here for your family? selling.
Well, people want fair value. Like if you're buying, like if you're selling, right? You at the end of the day, you just want to know that you're getting good value for the asset that you own. And again, like on the buyer side, if you've got a new investor in the space, they're on the other side of the trade, and they want to make sure that they're getting a fair deal as well. So here's a question that I have for you.
Mm-hmm.
Market efficiency. How efficient do you think the market is for mineral rights? And do you think that it is getting more efficient, less efficient? Where are we today versus where we're going to be in 10 years?
It's definitely more efficient. I think when I call it the institutional era of minerals have been around for 100 years. The unconventional shale boom was the beginning of the institutional era of minerals. So 2007, 2008, unconventional basins started to get developed by oil and gas producers. I would say 2012 onwards is when private equity and others start to come into the space. The first publics were formed in 2014, Viper Energy Partners in the Permian Basin, and then Prairie Sky up in Canada. So in the early days, it was so novel to just go and call the tax rolls in Texas and just call someone to buy their minerals, and that was the low-hanging fruit, Aaron. Now you have a lot more sophistication. You need if you're a professional manager of money and you want to put money into a fund, you want to make sure you're with someone who knows what they're doing. They have the correct land background. They have the correct disciplines in house to underwrite this stuff from an engineering standpoint. They have the right money, and so it's getting more efficient in that there's less layers of brokers just getting in the middle of something and flipping.
Yeah.
I think in the baseball innings analogy, we're probably in the fifth inning.
You think we're in the fourth?
Yeah, I think we have. Now, listen, sometimes there's a lot of a lot of different relief pitchers come in the 7th, 8th, 9th inning that stretches the game out. So it's not like from a time perspective we're halfway. I just think the pitcher out of the gate struck out the side, and the first few innings went a little quicker over this last decade. But the next innings of this game are going to be, folks doing really innovative things with technology, guys creating a really niche content platform like Minerals Guide to build rapport. It's just, there's going to be different ways to, attack this space and remove some of the inefficiencies. And I think that's what's fun. I mean, there are all sorts of new innovative things that folks are starting to do that enable them to continue to buy and are making the space more and more efficient. The public space will grow. Their technology innovation and blockchain and things like that are going to remove barriers to entry for retail investors. And so it's an ever evolving thing. I would say the concept of someone being like, man, I'm getting screwed on, someone's going to fleece me when they buy my minerals, I think those days are gone.
I totally agree.
It's competitive enough and efficient enough to where you're going to get a fair deal. Now, that being said, higher returns in general reflect taking more risk when you're an investor. So if title is really messy, if you have 50 people in a family tree and you got to go and aggregate all those folks for 10 acres, I mean, that is a lot of extra work. That's a lot hairier. A better return might be realized by the investor as a result of that, but they deserve that. They earn that. And that because you as that individual small owner that, hey, there's not a lot of buyers willing to roll up their sleeves and figure this out. I personally own some minerals in the Haynesville. It was a complicated title situation. Someone was in pay for 60 years, but there was no record of title. So when we bought this, we took the risk of maybe they don't own it 100%. As a result, a lot of buyers couldn't touch it. So there are nuances to every scenario where folks are willing to take more risk or roll up their sleeves, get in the dirt a little bit more to buy stuff, and as a result, might get a little bit of a quote unquote better deal. But in general, if you're out there and you're getting approached by buyers to sell your minerals, you're going to get a fair deal. I think you should be pretty comfortable.
I think that's right. I mean, I think if you look at every basin, Haynesville, definitely in the Permian, DJ Basin, even the Utica and Southwest or the Marcellus in Pennsylvania. If you own any tract of size, right, and I mean, if you own more than 10 acres, like you're getting offers, right? Especially out in West Texas. I mean, these folks are getting several letters a week, right? And they've got it's very rare, that I talk to a mineral owner who owns, call it more than 20 acres, and they don't have a very good idea of exactly where the market is, right? Because they're constantly getting offers, right? Yep. So, yeah, I mean, I think the days of, the shady landman showing up and buying your minerals for $100 an acre right before, the drilling rig moves in are really kind of behind us. And
for sure,
I think the market is definitely becoming more efficient, but I still think that there are a lot of inefficiencies, in the market. And a lot of it just has to do with the fact that the properties are so fractionalized, right? And there are opportunities for buyers in the inefficiency, and that's really kind of that's really kind of where we play, right? So yeah, I mean, we like to do the work to put things together to create value, right?
Technology is a big factor here. Digitizing land records and title. Not every county across the country is digitized yet, and there's holes in some of this. There's piecing the puzzle together. All that's the inefficiency we're talking about. And we're not talking about, the sleazy land guy coming and taking advantage of you. I just think it's, it's not a perfectly, fluid market that trades daily on the New York Stock Exchange. And so that'll continue to get better and better over time. The part of the market that is locked up in trust, like I had mentioned. Technology is going to, create liquidity in the minerals in the trust world over time. So, folks being able to automate engineered values and
totally,
things of that nature. So it just like the technology innovation on the drilling side, there'll be technology innovation on all the various aspects of the minerals game, which will just make it more and more accessible for folks out there who are interested in selling. And then interested in buying, the little plug for yourself, the program that you put together, kind of teaching folks the ins and the outs of mineral buying.
That's it, man. Yeah. No, that's we're super excited for it, and it's been awesome. So we've been launched for a month, and man, we're seeing a lot of interest. There are a lot of folks that are in real estate, or honestly, we've got a lot of folks that are in oil and gas, that work for unnamed operators, and maybe they work in the accounting department or they're an engineer, and they say, like, I just need, I want something to do with as a side hustle where I've got unlimited upside, right? So I already understand X, Y, and Z about the industry, or if you're in real estate, right? You heard about mineral rights, or you learned a little bit when you took your real estate exam, but you just have really no idea. I mean, that's really who our target audience is. It's folks that want to learn the industry, right? That want to learn the foundations and want to learn how a mineral buyer like myself actually finds the deals, right? So, I joke that I'll probably be the most hated man in minerals inside the next year when all these people start, participating in the market. But honestly, I'm a little bit of a disruptor, so I'm looking forward to it, and it's been super cool because I'm starting to, see, and like the feedback loop is awesome from the students as they're going through and they've got questions about this. I mean, it's definitely it's complex. Mineral buying is complex, right? But once you understand kind of the foundations, what are the data sets that you need in order to build a list, kind of understanding having a relative understanding of value, right, and how to formulate a value. And then what I tell my students too is that you kind of go into you establish your area of interest, build out your AOI, right? Use some general understanding to start building kind of a starting point offer for your area, depending on whether you're targeting whip tracks or white space or whatever it is, whatever your strategy is. And then you get out into the market and you get market sensitivity, and you learn really fast, really kind of where the market is. You start talking to folks, and I tried to make the course as much practical action steps as just mineral rights theory. You got to understand a little bit about property law and really kind of what mineral rights are foundationally, right, to participate in the market. But once you get past that, I mean, we really spend, module 2 and module 3 talking about like, how do you actually find deals? So we're super excited about it. And, for all of our friends in the space, if you've got a 25-year-old kid that's working in your office, that has no clue, maybe they're fresh out of college or business school or whatever, make them take the course.
It's a great training program.
That'd be the first thing that I would do, if I ran a mineral fund is, if I hire a new person, it's like, you're going to spend 2 weeks, you're going to sit through Stephen's course, and you're going to come out and you're going to have a much more holistic understanding of what our business is and how we find deals and how we make money. So I'm super pumped about it.
I think there's a huge potential that you're unlocking from the real estate world. And so, for those who invest in real estate, minerals are probably the most similar to triple net leases and how they kind of behave financially and everything. But a lot of the guys who kind of raise friends and family funds, a lot of it is real estate folks, because it's not a huge, jump to get comfortable with minerals when you come from the real estate world. A cap rate is really just your cash flow, right? Coming from the wells, and instead of rental income is royalty income. And
talk about one of the things that real estate folks have that they don't fully understand is kind of how we use leverage in oil and gas, right? It's a little bit of a different beast, right? In terms of, if I'm a real estate investor and I'm looking at a multifamily deal, right? I know that I need, 20 or 30%, of the cash up front in order to make that happen.
And then the rest is leverage.
Yeah. Talk about, kind of, leverage really kind of sub $5 million deals. I mean, I don't use leverage with my mineral rights business, but we also have better cap rates, so to speak, right, on oil and gas, right, because there is it is inherently, like, there are risks, but so talk about that.
So when I speak with investors, I always tell them, when you're building your portfolio and you're diversifying across asset classes, minerals are such a good complement to real estate. Real estate is it's a leveraged return asset class, and when the interest rate environment goes the wrong direction on you, you can be upside down.
That's a great point. Yeah.
And so I always tell them this is an equity driven return asset class.
That's it.
Minerals is. Typically, folks don't use any leverage at all. Going back to the ecosystem, the folks kind of at the bottom level typically will have a line of credit or something just to extend their buying capacity. But in terms of going and taking out 70% value on a mineral property, because you don't control development, it can be risky. You're paying interest payments over time. You might not have cash flow yet, and so folks typically prefer to use all equity. And the reason the returns can be in the teens or even in the 20s versus a 5 cap or a 6 cap in real estate is commodity prices fluctuate, and so that inherently opens you up to volatility. But volatility in its health will reflect higher returns, and so if you can kind of stomach that volatility, you can get some really attractive returns owning minerals without putting leverage on it. And so if you look at the last 3-4 years, it could be a really tough go investing into real estate because of the cost of debt. And so I always tell people, wouldn't it be great to have that lever in your portfolio to maybe ramp up minerals exposure in a high interest rate environment, or maybe 1031 real estate into minerals? And if your bread and butter, your bailiwick is in real estate, go back to real estate when the interest rate environment becomes more favorable again. And then you can kind of toggle back and forth, right?
Yep.
But there deserves to be a bucket of minerals and real estate in every portfolio, I think, not either or. And then there's certain opportunities, certain times in the market, it becomes more opportunistic to kind of go heavier into either of those. So yeah, that's the major difference. There's a lot of similarities in real estate, but you don't have cost exposure on the operating side going forward, and you don't have any debt on it. And we've mentioned the non-cost bearing aspect of it. What that really means is it's a hedge on inflation. And we've all been to the grocery store. My wife loves organic farm raised eggs. The blue ones, and you open the yolk and it's dark
orange.
yellow.
Yeah.
Oh, it's great eggs.
Yeah.
I mean, these eggs cost $11 a dozen.
Yeah.
It's wild. I remember when I was in college, it was $2 a dozen.
Oh yeah.
So inflation's real. I think this is the after effects of all the money that was printed during COVID. And inflation is here to stay. And when you own mineral assets, the cost of steel and rig equipment and hiring people to drill the wells and manage operations, all that goes up in an inflationary environment. So inherently, the cost of extracting oil and gas out of the ground goes up. In inflationary environments, commodity prices typically go up.
Yeah, or they're driving inflation.
So let's use a simple example. Let's just say an operator is making $20 per barrel profit margin. And in an $80 per barrel market, it costs $60 to get out of the ground. So 80 minus 60, $20 per barrel margin, right? Inflation now goes through the roof. Everything's more expensive. Service contracts are more expensive. Oil goes up to $100. Now it costs $80 a barrel to get out of the ground. Same profit margin for the operator, $20. So you think, oh, these operators are making all this extra money. It's $100 a barrel. Well, not necessarily, because they have to deal with escalating costs. Now, in those two scenarios, you're the royalty owner. Let's just say, for simple math, 5% royalty on $80 a barrel. Now you're getting 5% royalty on $100 a barrel. You're better off in the inflationary environment.
Yeah, the mineral owner wins.
The mineral owner wins. So that matters when you're constructing a portfolio on the wealth management side. To have an asset class that actually benefits and is shielded from inflation, and that's just not financial hyperbole. This is real feedback from professional managers of money saying, wow, minerals saved our ass last year. Right?
Yeah.
It's not to say, hey, put all your money in minerals today, but a portion of it I think makes sense, right?
No, I totally agree, man. All right, dude. We're at the airport, man.
All right. Well, thanks.
Going back home.
Enjoyed the chat. Going back home to Houston.
Yeah, this is awesome. This is going to be a new series. Driving in cars with mineral guys.
With mineral guys.
Thank you very much, Tim.
Steve, always good to see you.